Life just gave you a time machine. A time machine that you can use to go back and invest in stocks before they go up big time. But I understand if you didn't see it at first because it's been disguised as a big, scary recession. Today, I'm telling you what I think is the best way to invest during a recession. The methods I'm about to cover will teach you how to pick strong stocks, how to improve your timing, gain peace of mind, and of course, generate those profits. Let's do it. What's up, everybody? Welcome back to my channel. My name is Matthew, and today we're going to break down my best strategies for investing during a recession. Here's how we're going to do it. First, a little bit of background about why a recession is the best possible time to start investing. Second, the top 3 things I look for in a balance sheet, especially in a recession. Third, the strategy that I and millions of investors around the world will be using to buy in this upcoming recession. Let's kick it off with first, why recessions are the blessing of all blessings for investors. Now, there's a rumor floating around that more millionaires were made through the Great Depression than in any other time in history. Now, I haven't been able to find any factual basis to back this up, but here is why that might just make sense. Time after time following a recession, there have been several years of massive stock market growth, and the US economy has weathered a lot. So the odds of the stock market staying down at recession lows forever is very unlikely. This is why when a recession rolls around, a lot of smart money investors are saying buy, buy, buy. But a lot of other investors are locking themselves in their room, holding their pile of physical cash, saying nobody is getting my money. I say get in now while the sale is on. But Matthew, where do we invest our money? Well, the S&P 500 ETFs like SPY and VOO are always a safe place to park some cash. In simple terms, these ETFs track the performance of the overall stock market, and that's great as it begins to recover. But here is the issue with those ETFs that no one is talking about. They're boring. These ETFs are so safe and responsible. Oh my god, I hate thinking about it. Totally kidding, the S&P 500 is a great place to go. But recessions are also the best time to invest because that is when the best of breed emerge. Imagine it's like natural selection for stocks. A meteor just hit Wall Street and that analogy doesn't really work. Let's just say it's survival of the fittest, and the ones that usually make it through are the ones with good balance sheets, strong business models, what have you. And the best part, during a recession, they're on fire sale. But it's not always clear who's going to make it through while we're still in or approaching a recession. This is why next we're going to cover part 2, what makes up a strong balance sheet. One of the best ways to ensure your investment won't crash to zero is to look at the company's balance sheet. But there's so many numbers and items, it can be very overwhelming. So I'll explain the top 3 things that I would look for in a company's balance sheet during a recession. Let's do it right now. Number 1, are they capital intensive? The term capital intensive refers to how much money a company pours into physical or financial assets to make money. In other words, do they need to spend a lot of money to make a lot of money? An example of a highly capital intensive business would be an automaker, which has to pay for parts, machinery, etc. A business with a low capital intensity, I guess you'd say, would be like a web design service. Now, I don't believe there's currently a perfect equation or method to determine whether or not a company is capital intensive, but what most analysts tend to do is look at their capital expenses over their labor expenses. If their capital expenses are much higher than their labor expenses, it likely means they're spending more on equipment and things like that. And that brings us to the second thing I like to look at on a balance sheet, especially during a recession. Number 2, cash position. How much liquid cash do they have on hand? If it's not a lot, they may have to start selling their assets when business hits a screeching halt. A company with a higher cash reserve is likely to be able to weather the storm for longer. It's like if you had an emergency fund that could last you 2 to 4 months, like a responsible adult, and I had an emergency fund of $0. Who's going to have to start selling the things in their room first? It would be me, and all I have is this mug, so my Craigslist is in the description below if you want it. Now, this whole cash thing kind of ties into number 3. So number 3, their debt. Now, yes, I know that debt can sometimes be a good thing, but only if it's used in the right way. A simple prime example is real estate. If I want to buy this rental property and I know it will generate at least $1,200 in rental income every month, then I can go to the bank, get a loan, and I'll make sure that the interest on that loan or the debt that I have to pay every month is less than $1,200. Well, then it's a no-brainer. I would use that loan to buy the house. The rental income will cover the loan, cover the debt, and I'll have $200 left over. But when used poorly, debt can often lead to the downfall of a company, especially in a recession. With less sales, with less revenue, how are you going to continue to pay off your debt? To do a good job on your due diligence, make sure you know, where is this debt coming from? Is it a good thing or a bad thing? Is it responsible, irresponsible? And is this company taking action to slowly pay off this debt? But now, the moment you've all been waiting for. The best possible strategy, in my humble opinion, for investing during a recession. And that is dollar cost averaging. Now, I know many of you experienced investors are thinking, bro, come on, I waited this entire video just to hear this. I've done this before. Well, I've also used this technique for a while, even before this recession, but when I did some research, I found some stuff that still shocked me. And guess what? I'm going to be sharing it with you. So stick around, sit down, have a drink. So now that you know how to properly identify some powerhouse stocks with bulletproof balance sheets, thanks to yours truly, how do you go about investing in them for long-term gains? You just need this one strategy that mitigates risk, helps time the market, and removes emotion from the equation. Dollar cost averaging is when you invest in a stock, but you spread out your purchases over a certain period of time. Now, most, if not all, of the definitions for dollar cost averaging say you should be investing at regular timed intervals. However, for me, I personally invest when I see a big dip or when there's news. That's when I add to my position. I don't necessarily make an investment every week or every month. But do what works for you, try these out, and if you want to follow the technical definition, you will not be hurting my feelings. First, I'm going to explain how this works with a nice digestible example, and then I'm going to blow your minds with a chart that had me like, and even if you've done this before, I'm almost positive your mind will still be somewhat blown. How it works. We must first understand the opposite of dollar cost averaging, which is called a lump sum purchase. This is when you dump all of your cash or your majority of it into a stock position at the same time. People who do this often believe that they have timed the market perfectly. Well, no one can do that. No one. I've done this before. It's totally understandable, but it's extremely risky. One, because if the price drops further, you have no cash to reduce your cost basis. Two, if you watch the price drop, you'll be extremely emotional and you might make some rash decisions like sell it all for a loss. Now let's compare lump sum to dollar cost averaging. Say I use the lump sum strategy to make a one-time $10,000 purchase of 200 shares for $50 per share. Let's take that same $10,000 and use the dollar cost averaging method. Rather than make a $10,000 one-time purchase, we make our first purchase of $2,500 worth of shares at $50 per share. We let some time pass, then we make another $2,500 purchase at $40 per share. We then make another one at $30 per share and another at $25 per share. And before you guys go and tell me, Matthew, this is not realistic at all. Well, many stocks recently just shot straight down past 50% from their highs. So this is certainly something you could have done a month ago. Maybe it'll happen again. I don't know. And check this out. With the lump sum, you got 200 shares of this company. With dollar cost averaging, you were able to buy 295.8 shares of the same company. And yes, I know fractional shares aren't super common. I don't even know how you'd go about that, but it's just for the example. You were able to buy almost 100 more shares with dollar cost averaging than lump sum. And it doesn't stop there. And now for the moment you've all been waiting for, after the initial moment you were all waiting for. Charts that will blow your mind and show you just how powerful the dollar cost averaging method really is. Here we go. For the lump sum strategy where you bought 200 shares at $50 per share all at once, here's the profit loss of 3 different sell prices. If you sell all your shares at $40, you lose $2,000. Sell them at 50, you break even, and sell them at 60, you make $2,000. This is it, guys. You ready for your minds to be blown? Ready? Oh no. God, I really hope I didn't hype this up too much. All right, we'll just see how it goes. Here is the profit loss for the same prices and the same stock, but after using the dollar cost average method. After buying at $50, $40, $30, and $25, your cost basis is $33.81. I mean, guys, look at this comparison. Ready? At $40, instead of losing $2,000, you're making $1,831. Instead of breaking even at 50, you're making almost 4.8 grand. And at 60, instead of making $2,000, which is still great, you're making $7.7 thousand. If that didn't blow your mind, I'm sorry, but I am not disappointed. That still blew my mind just reading it to you guys. In summary, the market is so volatile and so irrational that the odds of you buying at the exact right bottom are like 1 in a bajillion, trillion, quadrillion. The dollar cost averaging method while you're in a recession mode or while the stock market is falling almost guarantees you a great cost basis or cost per share. And it will probably be somewhere around or near the bottom, and probably somewhere better than if you were to try and time it all at once. Additionally, the dollar cost averaging method means you don't have to have FOMO or fear of missing out. You don't have to have a fear of, oh my goodness, every day, is this going to be the day where we hit the bottom and rally? Oh my gosh, it went up and now I think it's going to go down, so I'm not going to buy, but then if I don't buy, I'm going to miss out if it keeps going, and you're just like, oh my goodness. But if you have the dollar cost averaging, you'll have some skin in the game. Guys, you have to remember, don't just keep dumping money into a stock that could go to zero. Obviously, right? If you keep dollar cost averaging into a stock that might never come back up, that is a terrible situation. The S&P 500 will probably recover, but not all stocks will recover. So I refer you to part 2 of this video where you will go pick a strong stock, be disciplined, and be smart. I hope this strategy works out for you guys. Let me know if you try it. It's worked out for me in the past. If you enjoyed what you just watched or the research that I've shared with you, then please punch that like button repeatedly, hit that subscribe button, and turn on those notifications. As always, we'll end with the quote of the day that is moved right here, and now it's in black ink because I think it stands out a little nicer. All men are sculptors, constantly chipping away at the unwanted parts of their lives, trying to create their idea of a masterpiece. That one is from Eddie Murphy. I really like this quote. It's a lot longer than one I would usually write on there, and it was a chore to write that, but guys, this is a good one. I think this hugely relates to your mindset, I guess a little bit to dollar cost averaging because you're sculpting your little cost basis. But more so, you are the one in control of your life. I can really relate to this because there are times when there are just negative influences that come into your space, and you have to realize, is it worth keeping this around? And sometimes it's a hard decision to let go of something like that, but it can make worlds of a difference for you guys. I don't know if anyone needs this quote right now, but if you do, I'm really glad I was able to share with you, and hopefully it means as much to you as it means to me. Thank you guys so much for watching. Thank you for watching all the way through. I really appreciate that, and so does the YouTube algorithm. I'll see you guys in the next one. Peace.